We bang on about the FTSE Global All Cap Index Fund. What is it and how does it work?
It is a fund on the Vanguard website. We are not sponsored by Vanguard, although we're open to offers. Email us. So let's have a look at this right now. So we go to what we offer at the top of the page. This is the Vanguard homepage,
which is vanguardinvestor.co.uk, and then we're going to see what they offer because we're trying to find this fund. So let's go to the full list of funds.
And there is a lot of funds, and this is actually where a lot of the confusion comes after we run the Rebel Finance School courses. People go, I want to open an ISA or a SIP or an investment account, and then they click through and they're like, which fund do I choose? There's too many options.
They have something like 80 funds, you said?
There's 86 different funds, and a lot of them are not what we're actually looking for. So what we're looking for is the FTSE Global All Cap as we wait for Vanguard's page to load. Come on, Vanguard, you can do it.
So the FTSE Global All Cap, as Alan said, is a global fund. It means it has all the countries that you can invest in around the world. So we're going
to filter by global, but you can see there's still 44 of them.
Yeah.
Which is part of the confusion people get to is I want a global fund, I want this, but like, where do I click? What do I do? So we've clicked on global, and then the start one's a life strategy, skip past all of that stuff. Let's get on to the actual one. Sustainable life, skip past all of that. Target retirement date, no.
Which you'll have seen in our other videos that we do not think is a good idea.
Yes, so check out our other videos where we explain what those are and why not to invest in them.
I found it, FTSE Global All Cap Index Fund.
Perfect.
Let's
find
click
out
on
fund details.
How it works.
And the headline figures, this is a global fund, which means it invests in nearly all investable countries around the world.
Which is about 50 countries.
And you'll see at the top here, NAV price, which is net asset value. Like, it's actually irrelevant to your ability to invest in it.
Yeah, and people think, oh, what if I'm only investing £100? Can I still buy this fund? And the answer is yes, you can buy partial units, and it just works out how many units your £100 buys, and it can be less than one.
Number of stocks in the centre is actually a really important piece. This is how diversified you are. So invest in 7,156 companies.
That's a lot of companies
around the world. The charge, 0.23%, which is how much of your money in there they take each year to administer the fund. And then the final bit here, risk, 5 out of 7. I would just like to point out this is volatility, not actually risk of losing money, which the entire finance industry has confused.
Don't
not
get
just
us
Vanguard.
Started. What does volatility mean, Alan?
It means the amount the price goes up and down, and because this is equities, there is a lot of variation in the price. It is very volatile.
I just wanted to draw your attention as well to this bit at the top. So every index fund will have 2 different types of units.
2 flavours.
You've got accumulation, and you can see there it says it reinvests any dividends and keeps it growing over time. And then it's income, which distributes dividends to you, and you take that as income. So it puts cash in your account, and then you can withdraw it and do whatever you want with it.
Yeah, so when you're investing, you probably want the accumulation version because you're not withdrawing from it. And then when you retire and live off your portfolio, you want the income version.
So let's scroll down. So it says the fund is a passive fund.
Boom, that's what we want.
That means there's no human getting involved deciding what should and should not be in the fund.
And making daft decisions.
And then it says it tracks the performance of the FTSE Global All Cap Index, this is called the
benchmark.
The benchmark. It's what the fund is trying to replicate, and that's provided by a different company to Vanguard, and then Vanguard matches this index as closely as they can. And then you'll see it says it's comprised of large, mid-sized and small shares in developed and emerging markets around the world.
So all of the sizes of companies in all of the countries. Excellent, super diversified. We've got the past performance, which is the amount it actually makes or has made each year. And this is actually a rolling number, so it changes each month because they do it from the month you're in for the year previously. So it's a little bit confusing because it will change every time you look at this.
And actually what Vanguard is trying to do is to match the benchmark as closely as possible. And you can see it's done pretty well. And even, when the fund made a loss in this year, a couple of years ago, you can see that still the fund is trying to match that as well. It's not trying to beat it, it's not trying to do anything else other than match what the whole companies in that index are doing over time.
So the information we've got is the overview page, price and performance, so that is the previous results and how much it costs. Portfolio data, which tells you what's actually in it. Distributions, which is the dividends, and costs and minimums. So let's have a little look at price and performance so you can see that, and then we'll go on to the other pieces.
So this will show you how the price has changed over time, what the current price is, and
which is this NAV price, net asset value, which is the total cost of all the shares divided by the number of people who invest in it.
So it just means how much it costs to buy a unit of this fund.
Then you've got the price analysis, which you can stretch the time period to see how the price changes over time, and you'll notice it goes up and down an awful lot. That's volatility.
That's the volatility Alan was talking about just now. And then you can see the past performance. If you just go back slightly, Alan, you can see the OCF, the ongoing charge for the fund, 0.23%. That's pretty good. I mean, it's not the lowest it could be. One reason it's slightly higher is because it invests in emerging markets, and that costs more to do because it's a bit more fiddly. The countries aren't as well developed in terms of their infrastructure, so it's harder and more costly for Vanguard to buy those shares on your behalf.
And this is one that we're more interested in, is past performance based on a lump sum investment. I'm going to click on since inception, which means when the fund started.
Which was November 2016.
So if you put 10 grand in November 2016, right now when we're recording this in basically July, it would be worth 17 grand, which is actually a pretty good return for 7 years. You've made 7 and a bit thousand. And you can see the little crashes. That's the COVID crash, the little crashes in the price as it goes up. But that's basically what we're looking for. And this is the kind of flat line with inflation, the Ukraine war. But you can see you get a decent return.
And actually, looking at the past performance, I think is kind of irrelevant because we're investing in the whole economy. We're investing and thinking that the whole economy is going to continue to do well. And if that isn't the case, we've got bigger problems than
exactly
what we're invested in if the whole economy tanks around the world and no companies exist anymore.
So here's the portfolio data, which you can see number of stocks, that means number of companies invested in. This is the fund, this is the benchmark, so you can see the deviation between the two.
So it's quite tricky for Vanguard to be able to buy all the companies that are in the benchmark, this 9,000 something companies that are in the benchmark. So actually it's that's why the number of companies in the fund is slightly lower, because they try and do a sample as best they can of the companies that are given to them from the benchmark.
Then you've got the median market cap, which just means the median size of the companies we're invested in.
So if you lined up all the companies in the fund and you took the one in the middle, that's the median size.
And this bit here doesn't actually really help us with what we're doing. It's actually quite technical information that doesn't really help us at all. The region exposure is quite interesting. That means what regions are we invested in? And you'll notice North America being the biggest, which makes up 63% of the fund. That is because North America makes up most of the global economy. So there you go.
They've got the biggest companies. Most of that will be the States. They'll also have a bit of Canada and Mexico in there. The States has massive companies, if you're thinking of like Apple and Tesla and Microsoft, Amazon, Facebook, which is called Meta now. You'll see Alphabet listed on the list of the biggest
Google.
Companies. It's the name it's the
Google.
Holding company for Google, yeah.
So you've got Europe, Pacific, emerging markets, Middle East. So it tells you where it's invested. The market allocation, that now goes down to countries.
Yeah, so you can see
the countries.
Of that 63% in North America, 60% is the US.
Sorry, Canada, you don't make up that much of the market.
And you can see there as well, UK makes up just under 4%. And we see funds where that you can buy in the UK that have 20, 25 plus invested in the UK. And we think that you should invest in proportion to the global market. So that's why we think the global funds are great, because that one has 4% UK and doesn't overstate what's in the UK. And even if the UK was doing really well, we would still say just invest in the global fund that matches the whole global economy.
Then you go down to what's called weighted exposure, which tells you which industries we're invested in, and that is weighted to the size they actually are in a global economy. So you can see technology is one of the biggest ones, like we're living in the technological age.
So people come to us and they say, oh, should I buy a technology fund because just those companies are doing well, or should I get out of technology because maybe they don't continue? The answer is no, in our opinion. Just carry on investing in proportion to the global economy. If those companies start to do better, then the index automatically allows for that and will be more heavily weighted towards that. If those companies don't do as well and their share price drops, then that will automatically be reflected in the fund. You don't have to do any thinking about it. It just happens for you. So you automatically own the winners and the losers kind of drop out.
And people also say to us, Donegans, you talk about being diversified, but then you tell us to invest in one index fund. Well, this is one of the reasons why it's incredibly diversified. You've seen how many countries it's in, and it's in every technological sector. Technology, consumer discretionary, which is basically retail and different things, industrials, financials, healthcare, consumer staples, energy, telecommunications. Like, you are invested across every industry, every country, and all the companies therein. And then you've got the top holdings, which you will recognise: Apple, Microsoft, Amazon. Katie went through those earlier. So that's the sort of what it's actually made up of. The distributions are the dividends that are paid out to you, whether you click accumulation, it gets reinvested, or income gets paid out to you. But this is like the yield, which is the dividends as of close of 30th of June, was 1.7%. So you get 1.7% of the value of the fund in dividends, and then it's just whether it's paid out to you or whether it's reinvested for you.
So reinvested will be the accumulation type of unit. Income will be where it pays it out in cash into your account, and then you can choose what you want to do with it.
And when you come to live off the fund, you would get the 1.79% in cash into your account, and then you would sell, what would that be, about 2.3% of your fund to make up the other, so you can live off 4% of it. Look at our videos on how retirement maths works if that doesn't make sense. Final tab is cost and minimums, which shows you how much it costs to buy the fund and what your minimums are to invest in there, which at the moment is blank, so it's obviously free.
Vanguard funds are extremely low, so it's 0.15% for the to have the account itself, 0.15% of whatever you have invested, and that's capped at 375. And then there's the ongoing charges, or you might hear it called the annual management charge, which is 0.23%.
And you click invest now, it adds it to your basket, and then you can choose your investment account, whether it's through a SIP, an ISA, or something else. So there you are. That is the review of the FTSE Global All Cap Index Fund and all of the information they display for you on that page. If this didn't make sense, send us a question, write it in the comments. We love hearing from you. And please do the Rebel Finance School. It will make such a difference to your knowledge about investing, because we often get asked, am I an investor? The answer is
yes.
You are an investor, because you probably have a company pension. So you need to get on top of this. Otherwise, it will be damaging your long-term financial position.